you're waiting for the perfect time to start investing, maybe you're waiting for the bubble, maybe you're waiting for a crash, maybe you're waiting for prices to be better, you're playing the wrong game. Investing needs a long time horizon. So the sooner you start, the better. But if you have no idea where to start or what to do, then this video is for you. I started my investing journey 17 years ago, and I'm only just starting to see the benefits of all that compounding. So if I was starting from scratch in 2026, this is what I do. So before you even start investing, you need to do a couple of things. First one is to clear any high interest debt. Now I'm talking car loans, furniture loans, credit card debts, anything you've got that's a high interest rate. High interest rate is anything above, say, your standard variable mortgage rate at 5 or 6% or something like that. So anything that goes up to your 10+%, you need to clear that immediately. That is the first priority. You've got a couple of methods for this. Some people advocate the avalanche method, where you go for the highest interest first. Then once that one's knocked out, then you go to the second highest interest. Mathematically, that works out better, but some people prefer the psychological method of the snowball method. And the snowball method is where you pick the smallest balance, and that might be $1,000, I don't know, store card, whatever debt you've got, and then you pay that one down first. That gives you a psychological win to build momentum off. So some people say that gives you better adherence because you're likely to get that win, get that dopamine hit, and then push forward. Whereas some people just like the avalanche method because mathematically that is actually the better way to do it. The next thing you need to do is build a buffer. You need to have a buffer before you even think about investing, because one of the big rules of investing is don't unnecessarily interrupt its compounding. You must give yourself that buffer, because if there's one thing that's for sure, there's going to be some kind of financial emergency that you need to fix or that you need to deal with. And if you need to then dip into your investment account, it's going to interrupt your savings, your compounding, and it's going to set you back a long time. And thirdly, you need to set a budget. So budgeting is, not some crazy spreadsheet thing. You can do that. You can go through. It can simply be back of the napkin, work out how much your expenses are, how much your income is, and then what's the difference. Then you can allocate buckets. You can often use what's simply known as the 50-30-20 rule, 50% on needs, 30% on wants, and 20% on saving and investing. If you can do that, that's great. However, in my experience, the best way to save a lot of money or invest a lot of money a lot quicker is to sort out the biggest expenses first. Don't worry about your lattes and avocado toast. Yes, that can help because every single dollar compounds for you that you invest, and any savings you can make are great. However, you've really got to think about the big ones. Are you paying too much for your mortgage? Are you paying too much for rent? Can you cut that down? Do you have transport? If we're in this stage, we were just talking about any high interest loans, that includes car loans. So you should have paid that down by this stage by the time you're starting to look to invest. But if you still have it, maybe see how much that car is costing you, and then maybe look to rectify that, which will give you more money for the investing. So the point is, you allocate things and then you have a buffer. That way surprises don't come in and interrupt your investing. Step 2, you need to think about your time horizon, because this very drastically changes your investment strategy. So I would recommend, if you've got something you need to save for in the next 5 years, let's say you want to buy a house, or you're moving overseas and you need some cash, or whatever it is that you have a near-term goal, then you would probably just keep it in cash. Find the highest interest savings account that you can and just invest into that. Just keep piling that away. The trouble with cash is that, one, it doesn't go well against inflation. So as inflation rises, it's losing its value. So you've just got to be aware of that. However, it is security and safety in the short term, especially if you need it for, say, like buying a house. However, if you've got a 5 years plus time horizon, maybe you've already sorted that out, or you don't want to buy a house, or you've already bought your house and you've got a 5+ year time horizon, then that's awesome. Then you're better off in the markets. Now, this is going to be pretty agnostic. I'm going to lean towards a share market in this, but you can look at real estate, crypto, whatever is going to be more comfortable for you, whatever you're going to see as the best benefit, and whatever you're going to have high adherence to. It also depends on your risk tolerance. So do you have high risk or low risk tolerance? Once again, I don't really know your situation, so I can't be too specific here. However, I can just give you the general information, and hopefully that helps. One important thing to note here is that over a long time horizon, most assets definitely outperform cash. Whether you've got real estate, shares, crypto, much better than having cash in the long term. However, if you do need it in that short term, keep some. Step 3, we need to talk about, now's your time to shine. You've worked out how much you've got allocated. You've paid off any bad debt that you've got. I say bad debt, but high interest debt, any consumer debt. And then now you've got a pool of money ready to invest in the markets. Great. Go you. You're ahead of so many people already. Now, the first thing to start thinking about is your super contributions or your retirement account. Retirement accounts, depending on what country you're in, are a great asset to put as much into as possible because they're tax effective and they compound really well over time. Often you will do that, and sometimes your employer will have an employee match, which is great because if they match up to a certain percent, you're definitely much better off putting as much into that as possible, because if they match dollar for dollar, that's free money from your employer that goes towards you in the future. So absolutely max that out. Then you can look at a low-cost brokerage account. This is all bent towards you investing yourself and not getting someone else to manage. I can do a whole video on whether or not you should get someone to manage it. I think a lot of the time it's pretty simple. You can do it yourself and you'll pay lower fees. So the best bet, because fees will compound against you, and the lower the fee you have, the more money that you will have at the end of the day. There's a lot of comparisons that you can do for low fees versus high fees and how much more money you make in a low fee investment account. Even if they're getting slightly better returns, often managed accounts won't beat the market anyway. Most managed funds don't beat the market anyway, so you're better off just doing it yourself, in my opinion. However, if you've got complicated or complex family trust structures and whatever, that's where you definitely need to get some outside help and some investment advice from someone who's a little bit more sophisticated and qualified to do so. So first you want to match your super and max out your super. That's great for the future and it's very tax effective. And then you go for a low-cost brokerage account. You've got a lot of them. There's like ComSec, CMC Invest, as a whole list. You got your Vanguards. There's a lot of differences there. However, you don't need to overcomplicate it, right? You just need to pick one, do some research on which exact funds, and that's kind of outside the scope of this video. Let me know if you want me to do a bit of a breakdown on some of the different funds you can get in Australia or around the world, whatever. If you want more information on that, I'll be happy to do a video on that. The main thing is that you keep it simple. You don't need to have one in each thing because you want to buy individual stocks over here or anything over there. Just simply pick a low-cost brokerage account and then sign up for it, jump through the bouncing ball, start putting money into it, and you're off to the races. Then all you've got to do is pick a product within there, whether that's an ETF or whatever share fund they've got within their system, and then you just invest in that. Step 4, start small, but just be consistent over time. So if you invest $100 a month for 30 years at an 8% return, you're going to end up with $140,000, give or take, having only contributed $36,000. Now that's a pretty good return on your investment, and that's just the power of compound interest. It takes a long time to get that initial push, but once you hit a certain point, it grows exponentially. And given a long enough time frame, your returns start making returns on themselves. The best part about this system is that you don't need to be a genius. You don't need to try and beat the market. You don't need to try and pick stocks, and you don't need to try and be a fortune teller, because I'm telling you, that game is not worth it. You don't need to be a hero. Don't need to be a genius. Don't need to try and get absolutely outstanding returns. Just simply buy a good index product and get a decent return and compound over time. Just maintaining that will get you better results than you trying to spend all this time and effort trying to pick stocks and be Rain Man. Which brings me on to step 5, diversification. So what you're not trying to do is you don't want to bet your whole future on one company. You don't want to put all of your life savings in one company because there's so many things that can happen. It is the single point of failure. It is the linchpin to your whole plan. And you are just hoping that they don't have a director go off the rails or some crazy thing happen to their share price, or one of their products tanks and kills a bunch of people. It's absolutely not worth it to put too much money into one company. That's where an ETF comes in. An exchange traded fund is where a company packages up a fund, funnily enough, buys hundreds or even thousands of shares across a whole sector or whole market, and that gives you good spread. So if they drop off, if a company drops off, it doesn't really affect your fund because there'll be another one to replace it. Now, a lot of the gains of these funds are often made up by the few high-performing stocks. And some people say that's a weakness, but it can actually be a strength because whilst maybe the market as a whole isn't doing very well, there's always going to be some companies that are doing really, really well. So quick down and dirty, the S&P 500 is the 500 largest companies in the US, and it's generally, since its inception, gotten about an 8 to 10% return. That's pretty good. Now, if you invest for a long time horizon, like 20 years, it's 100% success rate. You would not lose money. Where people lose money is by panic selling or jumping out at the wrong time or trying to time the market. You're not going to time the market. The future and the markets are just too complex. There's too many things. No one can predict what each thing is going to happen in the economy. No one could foresee what, industries were going to do really well out of COVID. even if you war gamed it for 1,000 years, you would never have picked a lot of the stuff that happened. So just buy the index, buy the market, and then watch as the markets grow, as companies invest in technology and infrastructure, and you're really just betting on the human endeavor. Is people want to make money. You're also betting on companies wanting to make money for their shareholders, which if you own shares, say in an index fund, that's you. So they want to make you money, so they're working for profits, right? One thing you can bank on, it's companies always trying to make more profit. So let's talk local versus global shares and ETFs. Locals can be good if you want to buy in your own country. Often there are tax advantages to this. Let's say you're in Australia, you buy Australian shares, you've got franking credits. So that means that the company's already paid its tax. You don't then have to pay as much tax when you see the dividend, right? Because that company has already paid the tax on that money, and you just need to kind of bridge that gap. So you pay less tax. But the benefit of going global is if your country is not doing well, you've now got exposure to global markets, which generally, if you've got an index fund that has the best companies in the world, if they're making money, you're making money. Another quick note is if you are thinking about going into a managed fund or having someone manage your money for you, they often have higher fees, which even if they're getting higher returns, which most do not, most actively managed funds underperform the index most of the time. And the ones that do, there's often a huge regression to the mean after a few years. So it's unlikely that you thinking that you're going to have these great people are going to outperform the market anyway. So don't pay higher fees for the privilege of them to not actually make you that much more money. Even Warren Buffett, who is renowned for beating the index and absolutely being one of the best investor in the world in history, has even said that a lot of his money that he's leaving to his wife, he said just to put it in an index fund. Don't worry about trying to get someone to manage it. There's no one he trusts to beat the index. Put it that way. So why do you think you can beat the index? I'll go on a little tangent here because I think this is worth saying. And I think the education system has, particularly in Australia, and if you're overseas, this is like a very Australian thing from school. So I've spoken to a lot of people about this, and a lot of them say the same thing. In high school, we often got taught I can't even remember whether it was social science or economics or whatever it was, but we got that fake stock game where you go on the website and it's like you get a bunch of money, fake money, obviously, and then you invest in the market, you pick stocks and you try and do it. And basically everyone loses money. And so everybody then just was, well, okay, don't invest then. Like it kind of sent the wrong message, in my opinion. But I guess teachers probably didn't know that, buying the index over whatever time would actually generate. I think that would be a better lesson if that was incorporated into it and then sold at the end. So many people I know had the experience where they tried it out on that fake simulator thing, lost money. Maybe one person out of the whole class made a bit of money, but that was about it. And then it put everyone else off, put me off. I was like, I don't know, this is crazy. Because most people, and I've seen this a lot too. So one thing that'll happen is another little side tangent here. I've seen a lot of people have kind of just jagged a winner. And honestly, you can do it based on what you think is good. Like you might be the biggest believer in Tesla and think, oh, this is absolutely crazy. I know guys that have gone super hard on, I don't know, lithium mines that are publicly traded because they're saying, oh, well, this is a great option because I know I've got an inside story from someone who says that it's an opening up lithium mine and they're going to send to China and it's going to go into Tesla batteries or whatever. And surprise, surprise, it's like 5-10 years later. And that stock hasn't really performed. So you might think you're doing things based on, logic and reasoning. And I'm absolutely going to crush this trade and I'm going to make so much money. Realistically, there's far more luck involved than what you would think. You think that you can pick a winner because I don't know, everybody thinks they're higher than average intelligence. And if you're higher than average intelligence, you think that you should be able to outperform the average. But it's actually pretty counterintuitive and it's not really likely to happen. Don't overestimate your ability to pick a winner. The most dangerous thing is that you do pick a winner and you have a win. I've seen this time and again, and then you go in again and you go in raw hard next time and you absolutely tank it. And you're like, what happened? Yeah, that's just the nature of the beast. Whereas if you'd invested in the index, you'd outperform massively. Step 6, automate it. So there was a Fidelity study that said that the best performing accounts were either forgotten or deceased accounts. So just hold over time and don't mess with it. You messing with it. Actually, this is a analogy that I just thought of off the top of my head. Oh, by the way, I'm doing this new thing. I usually do a lot of scripting and teleprompting, whereas I'm just kind of coughing this one. But anyway, for the 5 people that watch my videos, enjoy. So I think it's kind of like you buy the index, you do it over time. The only thing that can mess that up is you. This is like a very, very high powered rifle. So if you have a rifle with a good scope and it's a nice rifle and you aim it in and you sight it in and you've got it dialed in, zeroed nicely at 100 meters, where you point that, where that sight aims at is where the bullet's going to go. If that's properly set up, properly sighted in and done by someone who knows what they're doing, the only thing that can mess that shot up is the shooter. Realistically, because if you've got the sight on it and it's all in, by the time you pull the trigger, it's good. But you moving it, you breathing, you jagging it, or doing anything to manipulate that is the error. So think of the S&P 500 or your VGS or VAS or whatever your fund is as your high-powered rifle that's going to aim true, and you are the one that's going to mess that up by getting emotional, getting greedy or fearful or panic selling. Or hey, it's not easy, because seeing your whole net worth and your family's life savings tank like 10, 20, 30%, that's tough. It takes a bit of nerve, but you will be far better off in the long run if you stay calm and don't panic sell. The best part about automation though is if you've already done your budgeting, you've got that 50, 30, 20, and you've got a small amount going each time, you don't even think about it. I don't even check it. Check it occasionally. I don't really check my account. I just put in a bit each time and just let it do its thing. I'm not watching the daily swings. I'm not watching how much did I make or lose today. Like maybe I'll do it when the net worth is a bit higher and absolutely like watching these big peaks and valleys. That could be equally exciting and scary, but just set and forget, automate, don't get emotional about it. If you can make it boring, or even better yet, forget about it, that's great. And the final step is expecting crashes. Crashes happen. The market has crashed 19 times in 150 years, and the COVID crash recovered after 4 months. Most downturns recover after 1 to 3 years, and the longest one has been, I think it was 20 years. So if you bought right at the peak of that, that sucks. However, if you dollar cost average over that time, you're actually not going to notice. You're going to be way better off by the time that upswing happens. And they always seem to happen. It's not predicting the future. There could be a crash that we never recover from. That could be end of days type economy stuff. Hey, I'm not a fortune teller. But in the past, it's always recovered. It's always gone up. Crashes aren't bugs. They're features. And if you sell in a downturn, then you absolutely lock in that loss. You've just cashed out and you're never getting that money back again. You've got to buy in. And then if you miss the bottom and you try and buy back in, you've got to buy in at a higher price. So you've absolutely just lost a huge portion of your portfolio by doing that. So the thing you need to remember is don't panic sell, stay consistent over time, and don't get too emotional. Don't think of it as a fine. It's like, oh, I'm getting punished, because then you're more likely to go, well, I can't take credit for this. This is a Morgan Housel thing. But you think of it as a fee, not a fine. It's your fee for having an asset that grows over time. It's your fee for having compounding effect, that once you get to a certain point, you will see outsized gains. You will see huge gains if you hold for long enough over time. That's the fee, is the volatility. It goes up, it goes down. People are trading and the asset price is fluctuating. That is your fee for the gains of the stock market. Just pay to play and you'll absolutely notice you will reap the rewards. So quick recap. So if I was starting again from scratch, from total fresh in 2026, here's what I'd do. I'd make sure I paid off any high interest debt. I'd make sure I build a buffer. I'd set my budget. I'd plan my timeline and set a longer time horizon if possible, and pick my investments accordingly. I'd pick the right account. I'd pick a good account. I would buy diversified index funds. I'd automate. And then I would just try and stay as level as I can through any economic turbulence. You don't need to outsmart the market. You just need to be disciplined and consistent over long term, and you'll absolutely win. Thanks for watching.